this presentation is to analyze and interpret the last 5 years' financial performance of Kingsbury Hotel versus its competitors, namely Kaladari, Taj Samudra and Colombo Hilton. The comparison is between 5-star city hotels. The presentation also includes the corporate social responsibility initiatives taken by Kingsbury, which is an evolving business practice, which incorporates sustainable developments into a company's business model, which has a positive long-term impact on social, economic and environmental factors, which will lead to long-term financial performance. The Kingsbury, formerly known as Ceylon Continental Hotel Colombo, and the Ceylon Intercontinental Hotel at a later stage, is owned by Hotel Services Ceylon PLC, which is a subsidiary of Hales PLC, which was refurbished and reopened in 2013 under the brand name of Kingsbury. As a city hotel, the Kingsbury operating environment was one of heavy competition, with the rapid addition of star-class accommodation and the proliferation of the informal sector changing the entire landscape. The Kingsbury operated a total inventory of 229 rooms at Kingsbury Hotel and 40 apartments on a rental agreement at Platinum One residencies during the year. The growth strategy of Kingsbury included an increased focus on sales and marketing and the undertaken engagement across multiple channels while building effective relationships in different markets. Sri Lanka tourism enjoyed a strong year in 2018 and 2019, winning international recognition as a destination of choice and welcoming a large number of tourists than targeted. While civil tensions in some parts of East and Central Sri Lanka, as well as political instability arising from constitutional crisis during the third quarter did impact tourism, the overall performance for the year was a good one for both the formal and informal sectors. The unfortunate incident, which took place on the 21st of April, had an impact in the entire industry and the country at large. And we can see a dip in the financial statements as a result in 2020 analysis, which will not be covered during this presentation but is indeed worth mentioning. Now let's take a look at the financial performance.
Ratio analysis. It's a quantitative method used to evaluate business performance of an organization by using financial statements. Ratio analysis enables us to ascertain answers for few important questions for an investor. Why one business is more profitable than others? What returns are being earned through an investment? How solvent the company is meeting its short-term and long-term commitments, and how effectively the company is utilizing its assets. However, there are some limitations of ratio analysis as well. With that background in mind, we have carried out a ratio analysis exercise of Kingsbury and its competitors, which mainly categorizes into 5 areas, namely profitability ratios, liquidity ratios, efficiency ratios, debt management ratios, and investor ratios. Let us now elaborate one by one. Profitability ratios. Profitability ratios are one of the most important ratios for a company. Gross profit margin is one of the main ratios under profitability ratios. This ratio represents gross profit of the firm as a percentage of its turnover, which is the first level of profit which appears in income and expense. It is also important to have a healthy GP margin of a company, since this does not consider the overhead cost of the firm. Kingsbury is having a healthy GP margin above 50% on average over the last 5 years. In comparing with the industry average, Kingsbury is slightly below due to higher cost of sales. where Hilton and Galadari having higher average GP margin of 80% and 55% respectively. The other profitability ratio is operating profit margin. This ratio assesses the firm's effectiveness operating in the industry. This measures profitability of the operating profit as a percentage of investment. Higher operating profits leads to greater retention of maximizing shareholder value. On average, Kingsbury is operating with 9% operating margin, while Galadari is considerably ahead at 17%. Return on capital employed is one of the key ratios under profitability. This ratio measures the effectiveness of the investment made by the investor. What is the return investors are getting for their investment? This is one of the widely used ratios among investors due to three main reasons. This ratio helps to evaluate the overall performance of the business. Target return for the individual projects when it comes to investment appraisal. The third one, it also can be helpful in benchmarking and comparing competitor performance. Kingsbury is having a healthy ROCE over past 5 years, averaging at 8%. This would indicate the investors are getting value for their investment. On average, other competitors are having a ROCE substantially lower than Kingsbury, dragging down the industry average as well. The liquidity ratio is also one of the main important segments of ratios. Liquidity ratio measures the ability of the organization to meet its short-term dues as and when they fall due. Current ratio compares the current liabilities versus current assets. This also tells the investor how a company can maximize its current assets on balance sheet to satisfy its short-term commitments. Generally accepted norm is 2:1. This could differ based on the industry norms as well as company policies. Higher current ratio would lead to idle assets, which are not non-income generating assets. Quick asset ratio. Quick ratio. This also compares the current liabilities with current assets, excluding inventories. This ratio shows a firm's ability to meet current liabilities from more liquid current assets. Generally accepted norm will be 1:1. Quick ratio. This ratio also compares the current liabilities with current assets, excluding inventory. This ratio shows firm's ability to meet its current liabilities from more liquid current assets. Generally accepted standard is 1:1. One current asset is equal to one current liability. Could differ based on the industry's norms. Kingsbury has a ratio of 0.1:1, which means barely 10% of liabilities are covered by current assets. This is a very risky scenario. Then we are moving into efficiency ratios. Efficiency ratios measures how productively the company is using its assets. Liquidity is one of the most important element of running a business. Inventory days ratio. This ratio measures on how many days stock is being held before being sold. Lower the days, better for the company. General accepted standard could differ based on the company policy and industry norms. Kingsbury has consistently reduced the stock turnover days over the last 5 years from 13 days to 9 days. Days sales outstanding ratio. This ratio measures the average number of days taken to collect the payments on average credit sale. Days sales outstanding is one of the important ratios of working capital cycle, which is also referred to as days receivable ratio. Although the generally accepted standard could differ based on the industry, higher DSO, higher days sales outstanding could lead to cash flow crisis as well. Total asset turnover. This ratio indicates how effectively firm is utilizing its fixed assets. There is no benchmark of the ideal ratio that can be compared with the industry average and on past track record. Kingsbury has consistently maintained higher fixed asset ratio. Total asset turnover. This ratio indicates how efficiently the firm is using its total assets. There is no benchmark for this ratio, and this can be compared with the industry average and companies' past track records. Kingsbury has consistently maintained a fixed asset turnover ratio of 1.
Let's discuss about the debt management ratios, which is very important for the effective management of debt as well as equity capital for a better performance of the company. First one is gearing ratio, which shows how the company has funded its capital by way of borrowing as well as owner's equity. If the ratio is above 50%, then it's considered the company is highly geared. When we see the financials of Kingsbury, we can clearly understand company has drastically reduced from 126% to 20% over a period of 5 years. The next one, we have debt ratio. Here we compare the total liability of the organization with the total assets available. It shows how capable the organization is clearing its liabilities. A lower ratio is more favorable than a higher ratio. The Kingsbury's financials shows that company is able to bring down the ratio to 20 over a period of time, which is a positive sign, a favorable sign for the organization compared to its competitors. Interest cover, which is also one of the important aspects to understand how healthy the company is able to meet its debts to external parties like banks. So the ratio is calculated by dividing the EBIT by the company's interest expenses. If the ratio is higher, then it's understood the company is in a better position to pay its debts on the due dates. Kingsbury is maintaining a better interest cover position compared to its competitor. Investor ratios. In this, we are not going to discuss the dividend related ratios as we don't have the companies which consistently declare the dividends over a period of time where we are analyzing the financials. Earning per share. This is very interesting for the investors to understand the potential of the company. It shows the profit earned by the ordinary shares and which also reflect the financial health of the organization. Kingsbury is able to maintain a better position compared to its competitors and it's very attractive to the investors. Earnings yield, which shows the earning per share divided by the current market share per share. Earnings yield is inverse of the PE ratio and is one of the indication of value as a low ratio may indicate an overvalued share price, and also the higher the value is reflect the undervaluation of the share. Price earning ratio. The price earning ratio, known as PE ratio, relates to a company's share price to its earning per share. A higher PE ratio means that a company's stock is overvalued and the investors are expecting high growth rates in the future. Market to book value, which reflect the ratios of company's market share price to its net book value per share. The higher the market to book ratio can be interpreted as a market value the company's equity cheaply compared to its book value. Industry specific ratios, which is for the hospitality industries, we have several specific ratios such as average occupancy, average daily rate. Average occupancy is the percentage of the space occupied compared to its available space. Over a period of time, in Sri Lanka, we can see that occupancy is declining due to the less growth in the arrival rates of the tourists, as well as the new inventory is being introduced to the market. Average daily rate is the metric used in the hospitality industry to indicate the average realized room rental per day. ADR is also known as ADR, which is one of the key performance indicators of the industry.
In the previous elaboration, we touched upon the financial performance of Kingsbury Hotels in Sri Lanka. Now, let's have an analytical look at the non-financial aspects of its performance. Even though CSR, the corporate social responsibility, has become a major element in the global business scenario, in Sri Lanka, it's still in the infant stage. In this context, Kingsbury has done some major initiatives over the past 5 years, becoming a model corporate citizen in Sri Lankan business arena. Kingsbury has done some major investments in the socio-environmental development programs, keeping in line with some of the world's best CSR practices. As annual social support programs, Kingsbury has done blood donation programs, educational support programs, youth empowerment programs, and most importantly, breast cancer prevention awareness programs all over the country. As an environmentally friendly corporate entity, over the last 5 years, Kingsbury has invested heavily on acquiring technology in reducing water consumption and production of waste material. As a management initiative, Kingsbury Hotels are not using plastic straws or disposable cups in its managed property. By engaging in these CSR activities, Kingsbury has enhanced its corporate image and have become a pioneer in the corporate and socio-environmental protection drive in Sri Lanka. This has resulted in increasing their market share significantly and have given a competitive edge over and above their closest competitors.
So far, we looked at financial and non-financial performance of Kingsbury as well as the other competitive hotels. Now, when we looked at the performance, we looked at the profitability, liquidity, efficiency, debt management, investor ratios, as well as non-financial performance. Kingsbury is not doing so well in certain areas like profitability and liquidity. But when you look at the efficiency, debt management, and investor, they are doing pretty well. Even the liquidity, it looks like they have done some calculated risk. They have taken some calculated risk in investment. Let's see. When you look at the investor ratios, none of the hotels has paid the dividends except in 1 or 2 cases through the last 5 years. Now the liquidity ratios, Kingsbury is not doing so good in liquidity ratios, and quick ratio and the current ratio in particular. Let's look at where they are doing well. Superior performance is shown in net profit margin, the ROCE, and then the lower figure in day sales ratios.
and they are showing the best asset turnover among all these hotels that we have compared. Now, reducing from a high gear 5 years ago to a 20% low gear now shows that they have taken some calculated risk in investment, where investment on CSR as well as investment on other areas, which has shown dividends now. Kingsbury, if you look at as a company, would you invest? And why would you invest? Kingsbury has taken calculated risk, as I told before, and they have invested on CSR and other areas as well. Now, this approach has given them a lead in the market, and also, especially CSR, has given them a chance to improve their brand image. And all this shows that Kingsbury is one of the leading hotels in the hospitality industry to invest.